Good afternoon, everyone. I hope you can hear and see me. Great, so you can hear me. Thank you for joining. We'll wait maybe a couple of moments for others to join. Thank you for joining us in this very nice afternoon. Let's wait a couple of more minutes.
Good morning.
Morning.
Can we test the sound? Are you speaking now? No.
Yeah, no, I'm speaking now.
Okay, all right. Okay.
Can you see me now, guys?
Yes, okay.
Okay, perfect. So let's start. I'm sure people will join us as we go along. So first of all, thank you for joining us this afternoon. The beautiful afternoon here in Lantau Island in Hong Kong, and we wanted to share with you a couple of things today. Mostly, what I'd like to speak today is about what how we see gold and in this age of coronavirus. We would like to touch base and generally a little bit about gold for those who were not very familiar with this asset class, but also to talk a bit about, to talk mostly about what gold has been doing now, what we see in the precious metals industry at the moment, and very briefly touch base on what we, and I would say educational kind of notes on people who have decided to buy gold and what's the best way to do so. We'll have time for question and answers, so don't worry about it. I think the best is to keep those question and answers, write them in the chat on your screen, so we can as we go along, you can write questions there, and I'll attend to all of them at the end of my presentation. So assuming we are fine and that you can see me, right? So let me quickly make sure I can see you. Okay. So a few fun facts if you'd like. Sorry? Okay. If you'd like fun facts about what's happening, about gold, you can see we have a bit over 187 tons of gold that were mined so far since the beginning of civilization, and we have all the gold minted ever in the world can be only a cube of 200.
Jo, og det var sådan et mission to go China overseas, so var det noget, at this is from Hong Kong, and no.
Aha, jo. You can also then. Jag chansar ju håller på det net.
Jo.
Okay.
Okay. Yeah.
Guys, if you don't mind putting your microphone on mute, it will be helpful because we can hear you speaking. So let's start, and when I want to start from the basic, which is why gold, and I want to briefly go through the fundamental reasons why people buy gold and gold as an investment tool. The first one is the intrinsic value of gold. So gold has been part of our civilization since the beginning of humanity. Gold has been associated with wealth, with status, and with wealth protection really for 4 millennials. So it's only natural that it will still remain so this way when you think about it from civilization point of view. If you're thinking about the Oscars that are gold statues, the Olympics with their gold medals, even in English language, in other languages, we say more precious than gold. Gold has really been part of who we are as species in the last 4,000 years. And I believe it is safe to assume or safe to state that it will remain this way as long as humanity exists. And again, we can see in time like this, and I'll speak about it later, when there's a crisis, people feel security. They feel more safe, they feel secure when they have gold bars in their possession. The second reason for having gold is simply as the portfolio diversification. Gold performs very well in times of crisis. I'll show what it's been doing this year. But gold has been doing very, very well in times of crisis. So if you have a component of gold in your portfolio, you increase the returns on that, on your returns on that portfolio. And anything between 2% to 10% could be a good amount that will enhance your returns on your portfolio. So again, the idea of gold as a diversifier, and again, we'll see it shortly, is that it has relatively strong negative correlation to the financial markets, hence the strength it shows in times of crisis. The third reason is returns over time. Gold has been performing very well the longer we keep it. As a reminder, until 1971, gold was pegged to the US dollar. US dollar was pegged to the gold, meaning that every dollar printed, it was fixed in the dollar amount. Since 1971, when the gold standard was eliminated and gold was traded freely, actually, since 1971, gold appreciated in price on average of 10% a year. So it does provide returns over time. It doesn't provide a yield, and nothing is guaranteed, of course. But if you're looking at longer term, it provides good returns, which are basically in par with other markets, such as the fixed asset markets and the financial markets. The fourth reason we look at gold is as a wealth preservation tool. Gold maintains its purchase power. When we say gold maintains its purchase power, we mean that whatever you could have bought with an ounce of gold, let's say in the 70s, you could buy today. And even better, we checked lately the amount of cup of coffee you could buy with an ounce of gold in the 70s. Today you can buy 4 times more cups of coffee for the same ounce of gold. So the idea is, and we always say to clients, you are not going to be rich if you buy gold, but you definitely will help you keep your wealth because you can buy more than what you can buy in fiat money. We don't want to overcomplicate it today, but there's a nice graph which you can see on the World Gold Council that shows how all fiat currencies lose value with time while gold maintains its value. The fifth reason is it has a stable demand but scarce supply. Gold demand is relatively fixed. We're looking at jewelry, we're looking at investment, we're looking at central banks, we're looking at technology sector. All these relatively have, if you look over the years, they have relative very fixed supply as demand. However, so we're subject to mines being open to be able to extract the gold from the mine, which keeps it a commodity that is relatively scarce. The last reason I'm going to talk today, of course, there are 100 reasons, but the last one I'm going to mention today is the fact that it's highly liquid. It is what sometimes I say, economists do not agree with me, but we call it a global currency. So although it's not a real currency, it is in a way a decentralized means of exchange. So there's no government issuing it. The fact you can hold a bar of gold, you can sell it here in Hong Kong or in Singapore or anywhere else in Switzerland, in North America, and you can get hard cash money against it. So that's very important, especially again in times of trouble or when there's turbulences in the market. It's very important to remember that gold is extremely liquid. Now, we were bullish on gold even before the current crisis, and I go strictly, very briefly to the reasons that we were bullish on gold. I said it. You can see it back in December in our pre-coronavirus world. We had good reasons to be bullish on gold. The first reason, or one of the main reasons we thought it would be bullish, is the fact that the interest rates cuts. So if you look at what happened since during 2019, we're looking at the interest rates and we see what the Federal Reserve was doing in the US. We can look at taking down the rate from 2.5 back in May to 1.75 in March and down to 0. We're looking at what the UK 0.75%, almost down to 0 lately. So when interest rates are low, gold is more attractive simply because people don't have a reason to save their money in other assets, so they can put it in gold. The second reason we were bullish on gold even last year are the negative yield bonds. So negative yield bonds mean that investors are willing to pay money for the issuers of the bonds to keep their money. Usually it's the other way around. It's a government, they need our money, they issue bonds, and and they pay us a dividend and or interest on these bonds. But actually this year, 18% of the global bond market is actually a negative yield debt, which means that investors are feeling risk, they are concerned, and they're willing to pay stable institutions, they're willing to pay them actually to keep their money. And again, it shows that there are no other ways, even the safest asset, which is a bond, doesn't provide any yield. On the contrary, you actually pay money for this asset. And the last reason we talked about, we talked last year about being bullish on gold, is the fear of recession and the global debt. And again, it's hard to remember how things were in 2019. It seems ages ago. But if you remember, we had a trade war between China and the US, which put pressure on the economies, both in China, the US, and other countries. We had fears of recession. We had fears of collapsing the equity markets, not related to the coronavirus. So we had concerns about where the economy is going, even in 2019. As we know, economy is a simple thing, life is simple. We were moving out after 2008, and the question was not, is going to be a next financial crisis, but how soon the financial crisis will happen. And that was, again, not related to the coronavirus. Looking at the level of debts, 2019 saw a record high in the terms of debt, and that shows major concerns with investors on the ability of government to and other entities to pay their debt. We had the same problem here in China. Questions about the sustainability of both household and corporation and debt, and these still remain to be solved even as we move forward out of this coronavirus situation. The last thing, of course, that encouraged us and our peers to look at gold in a favorable way even before the coronavirus is what central banks did during the last few years. And for those who don't know, 2018 and 19 saw the biggest purchases of gold by central banks since 1971. And the biggest buyers of gold would have been China, Russia, Turkey, Kazakhstan. We have a very interesting case of Poland buying a lot of gold in 2019, actually more than doubling its gold reserves. And these activities signal the market that if the central banks are buying gold, they know maybe something the investor doesn't know. They know why they accumulate gold, because they're concerned with something. One reason. Second was a political issue, especially on behalf from China and Russia. They wanted to de-dollarize their economy, and one of the best way to do so to get rid of US dollars debt and buy gold instead, and to stabilize their currency and give it value. Poland is an interesting case because Poland, again, almost doubled their gold holdings, and the governor of the central bank mentioned that the reason for that is their financial security. So again, looking at all these aspects, the debt, the trade war and other geopolitical tensions we had in 2019, and what central banks are doing, obviously we were very bullish on gold even before the current crisis. Now let's go to what we're having now during the COVID-19, the coronavirus. And it's interesting because being here in Asia, Hong Kong, even the doorstep to China, we realized things are getting wrong quite soon, sooner, of course, than the Western world. And we saw how it swiped through the country. We saw it in Wuhan in December, later affecting other regions in China. By mid-January, Hong Kong shut down, or mid-late January, Hong Kong shut down. Education system, government offices, and later on shut down all actually government activities unless they're essential government agencies recommending staying at home. We had a second wave coming in. And of course, the financial effect, the immediate financial effect is just unimaginable. If you'd like, that's the first time globally, humanity, no matter where you are, you experience the same thing on roughly at the same time. That's something that I would say probably will do a lot of research on the sociological aspects of it. But from a financial point of view, the world has been put on a hold. Everything was frozen. Being here in Hong Kong, you felt like you're in a car and someone turned off the switch and everything is idle, or someone said everything is under hibernation. And this is kind of the framework of where we are now. Of course, things seems to go better this time, but there are unpleasant surprises. Here in Hong Kong, we had a second wave. Singapore experiences a massive increase in new infections and is literally shut down until June. So it's far from being over. The UK, Boris Johnson said a couple of days ago, this is the most dangerous part of the crisis, because this will decide if you're going to leave this easily or not. So let's look at what we see as the three major effects this crisis had specifically on the bullion industry. The first thing, which is very, very obvious, is supply chain disruption. And we feel it every day in our business. So refiners, mints, mines, everyone are shut down. So we have from the Perth Mint in Australia to New Zealand Vault, where we store some of our clients' Vault, all the way through Singapore, Hong Kong, Switzerland refiners have been shut down for a few weeks, Royal Mint, Royal Canadian Mint, the US Mint, and so on and so forth. So what we see on the refinery side, we see either total shutdown or working in under capacity because employees are sick, because they can't get to work, and various other reasons. Same applies to the transportation and logistics. Transportation, because gold is being shipped using usually commercial flights. And the moment air traffic came to a halt, that means trouble to the logistics around precious metals. So if you remind, in Africa, you need to get your material out. There's no way of doing it. And if you are, and I'll talk about again shortly in the context of the COMEX, if you need to ship gold, it becomes increasingly difficult. Earlier today, I saw a quotation of one of the logistic companies, which quoted shipping of gold between Hong Kong and a couple of other major centers, New York, Dubai, and London. The minimum quantity the logistic company can ship is 800 kilograms, which is a lot. 800 kilograms in the world of physical gold, especially for investors, is a lot. That means we are working under very, very stressful limitation in terms of our ability to get material, to move it around, and the supply. We had a mine that sent us gold for sale. They had to accumulate 5 times more the amount of gold usually they sell, just because they couldn't get that gold out of the mine. So that's one of the major issues we have. The second interesting phenomena we saw is the huge gap between the COMEX future contracts and the spot price. So just to remind you, the spot price is what you can see on Bloomberg or Reuters or other financial terminals. That's meaning the price of paper gold in London, and another price discovery mechanism is through the futures contract. Now, usually there's a few dollars spread. We still see very big spread between the COMEX and the spot price, up to 70. It's one point, it was up to $70 gap between the spot price and the future market. And the reasons for that are, again, big demand for physical, stressed by investors that maybe the COMEX, which sell future contracts, maybe they don't have enough gold to support the delivery of their contract, and fears about lack of supply. Someone even one person even quoted that it may even have been the cost now, as I mentioned, the cost and the difficulties in moving gold from the London vault to the COMEX vaults in New York. The result is, as I said, very big spreads, and I'll touch that again in a moment. And of course, we live in extremely uncertain circumstances, and gold flourishes on uncertainty. Again, that's one of the reasons we were bullish on gold in 2019, because we saw a lot of uncertainty in the market. Of course, this is now enhanced. Nobody knows how we're gonna live out of this, what we now call, as you can see, the great lockdown. It became now, it's gonna be a very a term that it's gonna be used more often about the great lockdown. And this uncertainty actually caused the price of gold to increase. So in terms of the price of gold, with the third thing we saw in this last few months, we reached a 7-year high. So we reached 1730, it went down a bit, but we saw it get up to 1730 an ounce, which is extremely high. And one more thing we don't mention here is the high volatility. Gold became quite volatile in the last few months. When we saw, you can see here, we see the ups and downs of the gold price. We see here, you can see this drop, which was quite surprising. But again, we believe people sold their assets to cover on other losses. So you can see this price, both volatility and appreciation since the beginning of the year. If you want to see it on a year-to-date basis, again, look at it, it speaks for itself. Look at the gold and all the rest, kind of a green light in a big red, in a big sea of red. Of course, it's not gonna stay this for long, but again, for me, it shows how gold proves itself. Every crisis, it's just unbelievable. Every crisis you have, gold suddenly stand out. People think it's a relic. They say, oh, we don't need it. There are other assets that bring better yields or better returns. And then you get to this crisis and see it speaks for itself. The result of all these phenomenon are shortage in supply of silver and gold, because on the one hand we have high demand, people freak out, people run for safety. On the other hand, we have major difficulties to source gold and major difficulties to move it around. And the result is a shortage, and the premiums have gone rocket high, up to 10% of the regular premiums. Now again, to emphasize, the price we see, the spot price, is the price of paper gold. When we move to physical, there is a premium, which reflects supply and demand, reflects the cost of manufacturing the physical product, and reflects the cost of transportation. The premiums are to the point that lately I saw a silver offering at a premium of 60% of the actual price of silver. Now, we may look at it as a premium. I look at it as perhaps a deviation between the paper market and the physical market. It's true, on the physical market, we have two components, spot plus premium, while on the paper market, we have one component. But if you combine the physical price to one component, the price of silver today is not $15.3 an ounce. It's actually $20, $21, $22 an ounce. If we're selling gold coins, we sold gold coins earlier today, we're selling them at $1,850 per gold coin, although the spot is $1,720. So there's $130 premium on gold coins. So this is the result of what we're seeing in all these major disruptions in the market out of this phenomenon. Another element that's not here is, and I mentioned the gap between the COMEX and the spot, is that price discovery has been quite difficult these days. So if you look on, if I look at a few retailers in Singapore, their spot price could be 20 and 30% 20 to 30% dollars more expensive or higher spot than the one we're seeing. Why? Because if you're hedging, if you're selling gold and you're hedging your risk, actually you're going to the future market. If the future market is 20, 30 dollars more expensive, then actually you are paying, you need to pay more to hedge your risk. So if you rely on hedging, you rely on hedging products, actually this gap between the COMEX and the spot is quite significant, and quite significant from I would say investor point of view, because you may end up, some investors end up paying more, not only on the premium, but paying more on the spot price. To recap, kind of, or to last thing to mention about what other metals did this year, they wasn't so lucky. We had silver going down 15%, which surprisingly is one of the reasons clients buy silver, because investors believe silver now is underpriced compared to gold. There's the famous gold to silver ratio, silver to gold ratio. It's relatively very high historically, meaning that the silver is underpriced. Silver is industrial metal. Apart from its investment purpose, it's industrial metal. When there's a recession, there's less demand for silver, which means the price will go down. On the other hand, that means investors want to buy more silver, but there's less silver to buy, and whatever you could buy is more expensive. Just as a information, we're taking orders now for silver, which will not be fulfilled in physical metal, at least in the next 6 to 8 weeks. So our clients who buy silver now, most of them actually expect delivery sometime in the summer. They fix the price now, they'll get the metal actually in the vault under the name in a few weeks, because the refineries, they cannot provide they cannot meet the demand, I'm sorry. And also, after being shut for weeks, refiners will prefer to work on gold products, where their financing costs are heavier than on silver products. Platinum, again, 20% down. Platinum is a metal used for a lot of diesel engines. Less demand for diesel engines regardless. So we saw a slow decline in the price of platinum over the last few years. And of course, in a total lockdown, a great lockdown, nobody's buying anything, so they don't need platinum. Same goes for palladium, very modest, I would say, decline in price. Palladium is used also for hybrid cars. So there is some actual demand there, but it was doing very well in the last 2 years. What we may expect is that, or I expected, some type of a bubble. And there was a correction in 2019 and not a big correction this year. So it's still doing quite nicely. Next, I want to do what to expect in the short term and the long term. And of course, any attempt now to predict is doomed to be failed, but I will try my best of my luck to give some general assumptions. The good news is that it seems that we are gradually, country by country, getting away from this crisis. So the bad news is we don't know yet what will be the long-term effect of businesses shut down, of people unemployed. I expect some political, I would say, issues in most countries. Voters, the electorate will be unhappy with being unemployed, with having no money. That's one thing. Second, of course, that's a major concern. I'm sorry, is the unemployment rate and the fiscal deficit. So when you look at the US, which is already has a ballooning debt, which one of the reasons gold is relevant is because people are afraid of this debt. But then you're looking at them spending 2, 3, maybe even $4 trillion, which basically means printing money. Same for the ECB, for the European Central Bank. They're going to print their own money. I just read only on Air France KLM, the French government and the Dutch government combined, they're going to give them almost 10 billion euros. This money has to come from somewhere, and mostly coming from. So when we look at this is a very big concern, is the debt problem. How will government solve it? And the second problem is the depreciation of fiat currencies. Longer term, there are fears of inflation because the meaning, the meaning is that there's going to be some cheap money available for investors to spend, which may cause property prices to go up and other assets to go up, and ballooning some of the markets, some of the financial markets. From our industry, premiums are already getting more reasonable. So assuming no major second or third waves, what we will see gradually, and you're already seeing this in the last couple of days, there's a bit more supply of metals. The premiums are a bit more reasonable. It's still high, especially for products coming from North America, but Hong Kong is almost in full capacity, refining capacity. Same for Switzerland is slowly coming back to work, and the more material leaving. We had some gold deliveries leaving both the refineries in Hong Kong and Switzerland this week to our clients. So that's coming better. The physical, the premium on the physical is getting down a bit, which is good for investors for what we do. In terms of pricing, Standard Chartered seeing the price 17.25 as an average, which we agree it's basically around that already. And Bank of America surprised, saying that they expect gold to reach $3,000 by October 2021. This is a major question. I have no answer. Our assumptions are more conservative. We're looking at a history and we're saying gold is doing an average of 6 to 12% a year. So we're looking at it from this angle. Of course, it's doing more this year, but it really depends how we're going to leave this crisis and what governments are going to do. And now industries are some, like the tourism industry. Is the recovery going to be fast or going to be slow? Or the financial market's going to recover fast or slow? We don't know yet. And if you'd like, we look at it like a hurricane that passed through a village, and you don't know how much debris is there until the storm is over. The sky is clear, and the rescue team can go to can reach the site and see what's going on. That's what we expect to now. Everything now is still, in my opinion, kind of a guessing game. We'll have to see probably in the summer, July. We'll see the tourism, we'll see the financial market. We'll have more idea. But at least I'm definitely thinking the price of gold, even if we're not going to go major high this year, it is done well enough. And the problem is investors are concerned with what government will do and with all this printing of money and the second quantitative easing past 2008. This in a nutshell, this is on the effect of the virus and what to expect. I want to touch this very briefly a bit on because we get a lot of questions on clients, especially now, asking, okay, I have ETF, I want exposure to gold, I see what it's doing, how is this done? And the main question a lot of time being asked is whether the ETFs or whether to call unallocated holdings or paper, comics, futures, and so on are safe enough. Definitely, my answer is a negative. Physical, if clients looking for security, physical is the best way to go. And there are the two main reasons, and I'm not going to dwell too much about it. The two main reasons are, A, physical gold, you have no counterparty risk. You hold the bar, it's yours. You're not subject to any third party issuing it in questions about their I would say, good standing and so on. I'm reminding here Lehman Brothers, that was too big to fail. We don't know what's going to happen. And if you, an ETF at the end of the day or future contract mostly are promissory notes, and you rely on the third party to honor these commitments. The second reason is having 100% of the underlying assets allocated under your name, which is extremely important, especially in times like this. So again, if clients looking for short-term exposure, there's nothing wrong with ETFs or with futures, or here in Hong Kong, you can log to HSBC and buy gold. But if you read the fine print, you read there's no gold, there's no liability. If you lose your money, you're doing it at your own risk. So again, security reason, buy physical gold. And the eternal question is how much. Ray Dalio, gracious enough to say 10%. The World Gold Council checked analytically, and anything between 2 to even 15% can enhance the returns on your portfolio in the long run. For those who don't know how a physical gold bar looks like, this is how it looks like. And that's important because that's how clients get the assurance that the assets is there. You have the refinery hallmark, you have the purity, you have a unique serial number that make sure you are getting your own gold bar and not fractured ownership or unallocated holding. I have a long conversation with a client this week. We're thinking of choosing a solution, which means unallocated gold holdings and kind of an online exchange. Again, these products are very good for short term, and you think things are going to be fantastic. If you're afraid of systematic risk, of financial crisis, then then you need to have your own allocation to your own gold bars. And of course, keep it within the London Bullion Market Association, meaning refiners, logistic companies that are members of the association. And very important, when you buy gold, don't put it in a facility like this. This is a real photo from a facility in London that got robbed a few years ago. It was an old facility with no insurance. And you can see here, these are real safe deposit boxes that opened and got opened and see over 200 million pounds got stolen there. So make sure you have insurance coverage, make sure you have liability, you use a new vault. And the next thing is, of course, choose where to store your gold. Again, this is a matter of risk perspective. And I can tell you what we've seen the last few weeks is a shift, because we see a couple of things. We see clients want to take gold and silver products home because they're afraid of total meltdown, no ATMs, no cars, no public transport. And we did see in a few countries, we saw problems in public transport. Public transport did put on hold in some jurisdictions, or they want to diversify. They want to diversify, they want to put it in few locations, they want to share their holdings in a few locations to make sure that they are safe. And one comment that I have is that, and I'm biased because we're based in Asia, but we can say, and we see it now, probably Asia is the most functioning jurisdictions during this crisis, both Hong Kong and relatively so Singapore. So in terms of access to metals, the ability to trade, we haven't seen things like we've seen in the US. In the US, we had big bullion dealers that shut down for a few weeks because they had to move their inventory away from, let's say, New York. So actually, we consider now Hong Kong and Singapore to be extremely safe, and they've proven their capability and the disciplined population that are capable of keeping in line with the government instructions and keep themselves safe. Before I go into some questions, again, if you look at a well-balanced portfolio, you want a balanced portfolio, you want to mitigate risks, and you want liquidity, which is extremely important. All these give you the protection and the financial security element of gold. If you're looking at depreciation with a minimum risk, that's where it comes into investors' portfolio. And of course, before I'll give you some time for questions, of course, I will have to say a couple of words about who we are. So in case you don't know us, we're a family bullion company based out of Hong Kong. We have offices in Singapore and in Manila. And we provide 4 services. One is purchase and sale of precious metals. Of course, everything is physical. The logistics services around it, the transportation, the storage, we arrange for that. Safe deposit box services. And we offer finance based on gold as collateral. And again, this is very useful time like this. We have clients that they need cash. They need to close their margin calls on other financial products. They don't want to sell their gold. The easy way to do it is basically to collateralize the gold, keep under their name, and then take the money and put it elsewhere. these are our team, our very team that's working, I have to say, working very hard these days, because as I mentioned, every trade takes a long time. We work harder on every trade because we need to source the metal, we need to find a way to transport it, where to store it, where everything else is to try to find the material, and that's not the easiest work these days. I will let you, I perhaps let some, see if there are any questions. I think we have, let me see if you have any questions from the people. And I suggest to do it by the chat, which I'm going to look for it in a moment. Okay. So the one comment here saying that it is good to buy bullion bars that are older than 5.0. It's difficult to resell in the future. Gold is gold, meaning that again the question is how old the bars are. Does it matter? It doesn't really matter because gold is gold. You can always melt it and liquidate it. One thing we saw, and we see it a lot of the time when gold moves from, let's say, from the London vault, where gold is, can be, I saw gold bars that refined by Russian refineries that went out of business already. So it's been 20, 30, 40 years. I wouldn't buy that. So usually what happens is those old gold bars are being refined and are being recast to new bars with certificates, something that it's a bit more easier and accepted. So there's nothing wrong with old gold bars as long as they are refined by refiners that are currently members of the London Bullion Market Association. And again, the reason is that we want to be able to keep them liquid. So as long as the bars are recognizable and they're in vault that is recognizable in the London market, we can sell them very quickly. Otherwise, we need to melt them, and it just takes longer. And again, talking about disruption in supply chain, usually melting gold bars, making sure the real gold bars is a matter of a couple of days. We're now looking at 2 weeks because the refiners are in full capacity. They don't need gold. They're sitting on mountains of gold that they're financed. So they need to get rid of, they need to refine their inventory before they can take actual inventory. So we saw refiners in Asia and in Switzerland not taking any new material lately. Okay, we have another question. Is it better to buy kilo bars or smaller bars and coins? It's a very good question, and it really depends on the amount and the purpose. And I used to be biased toward the 1 kilogram bars because they offer the best premium relative to the price, and they're acceptable everywhere. Now, I changed my opinion in the last few months because again, these last few months were exceptional. Even for me, I've been doing this for 10 years. The team, these are exceptional circumstances. What we realized is that we need to have some way, I would say, to liquidate in smaller denominations. So for example, the 100-gram bars became quite a bestseller for our clients because they can sell in $5,000 batches rather than $50,000 batches. So I would say if my tip would be if you plan a sizable purchase, buy both. Put the bulk in 1 kg bars. That's kind of safe money. Don't touch it, but have some coins or some smaller bars. If you're looking at a smaller transaction, buy the smaller bars. By all means, anything below $100,000, $150,000, I would buy 100-gram bars. Coins are good. Coins are very expensive now. So again, the US Mint is shut down. The Royal Canadian Mint is shut down. So the premiums on our coins are extremely high, and you will not get those premiums back when you sell the coin. So let's say if you're buying now gold coins for 7% or 8% premium, when you're selling them, you will not get 8% over the spot price. Unless, again, it's a very unique circumstances. You will get maybe 1% more than you will get on the smaller bars. So if you're thinking of small investment or something that is easily be easily liquidated. 100 grams to 50 grams are good enough. 250 grams are good size of transaction, and coins are great if you want to keep them at home. So we do have clients, and it's something that say a lot of American clients, German clients, and Filipino clients. They would like to have coins at home because they're thinking of the rare scenario where they need to go. There are no ATMs and they want to buy bread. So they have a coin that they can give if necessary. Any other questions? I'm happy to answer. No other questions. So I would like a couple of words to summarize. And if you have any questions, you can still pop it on the chat, but I'll start wrapping things as we get into the 45 minutes mark. Couple of things to bear in mind. A, gold has proving its value in times of crisis. That's and again, if I look at the if I'll pull back the chart on the of the performance of gold in the time now. Let me find it quickly. If I look at the chart of the performance, then you can see gold has definitely proved its value in the long term. So okay, I'm not going to put it now because I can't find it, but definitely proved its value in times of crisis. There you go. So again, putting this here definitely proves it's relevant, especially this time. So if clients say, why should I buy gold? This chart is the answer, because when everything else goes down, gold goes up. Second thing, what we see now are those major disruptions. And again, that made our life difficult. It made clients pay more money a little bit. These are very, very unique circumstances. It's very interesting. So bear in mind the gap, the bid and ask price due to the COMEX futures contracts. Bear in mind the disruptions in the supply chains, which means don't ship gold, don't move gold around now. It's not safe, it's expensive. If you need to move it, park it somewhere. That's what we do with our clients. We park it, we wait for this storm to be over, and then we'll move it to wherever they want to. And of course, the major thing is to remember that at the end of the day, we're looking at an asset that will perform very well in the near future, because we are heading into, the IMF said, it's the probably worst financial crisis since the Great Depression, meaning governments were going to print a lot of money, which means your fiat money is going to be worth much less than it's worth today. On this tone, I would like to thank you, all of you, for joining us today. I hope it was interesting. If you would like to get a copy of this presentation, feel free to shoot us an email and tell us that you want this. We'll be happy to do that for you. And I hope you'll stay healthy, both financially, mostly your physical health is the most important, but also stay financially healthy, you and your dear ones. And I thank you again for your time.